Welcome to Success Series. Today we are going to talk about IS1, Presentation of Financial Statements. Let's dive into the standard. Now let's look at the objective of IS1. Now the purpose of the financial statement is to provide information about the first one being the financial position, the financial performance, and the cash flow of an entity. And this is useful, will help the wide range of users in order to make economic decisions. Now let's look at the various components of the financial statement. We said an entity should prepare a complete set of financial statements, including the statement of financial position as at the end of the period, a statement of profit or loss, and other comprehensive income, or statement of comprehensive income, a statement of changes in equity, a statement of cash flow for the period, and then the note containing a summary of the significant accounting policies which have been used and other explanatory information. Now let's look at the general features of the financial statement. Now we say the financial statement should be fairly presented and should be compliant with the IFRS. This implies that what you are presenting must be actually what is on ground. So there must be a fair representation of what we have presented. That's what you have shown should be a true reflection of what is actually on ground. Then we have the second aspect saying that it should be compliant with the IFRS. This implies that the information provided in the financial statement must match to its respective standards or the IAS in place. So it must be in line with such standards or IAS in place. So in case we have anything dealing with property, plant and equipment, we have a standard for it, IAS 60. It should be in line with that. If you have anything dealing with revenue covered under IFRS 15, it should be in line with it and the others. Now let's move on to, we have the going concern, and here we assume that the financial statement on an entity will operate for the foreseeable future and hence should reflect it with its financial statement preparation. Then we have accrual basis of accounts, which states that we recognize revenue when they are earned and not when they are received, and expenses when they are incurred and not when they are paid. We have the materiality and aggregation, which suggests that we aggregate items which are similar in nature and items which are not similar in nature, we disintegrate them or recognize them as a single line item. Then we have the principle of offsetting, and offsetting here implies that we can offset an asset and a liability, and here bear in mind that you must follow that particular standard in place. Then we have a frequency of reporting, which connotes the how we are expected to present. Either we are presenting yearly, semi-annually, or quarterly. Then we have comparative information, which suggests that our financial statement must help us to be able to compare, and here the comparison can be with just one entity. We can compare 8 different time periods. That we can compare an entity 2020 financial statement with that of 2021. So that will help us to compare for time periods. Also, we can compare different entities, and that will be entity A. We can compare its financial statement with that of entity B. And then we have consistency of presentation. This connotes that once you have chosen a specific procedure to follow in presenting, you must stick to it. Then we move to the statement. Then we are diving deeper into the various statements that we have, and we are starting with the statement of financial position. Now bear in mind, the statement of financial position helps us to know the financial status of an entity, and here it follows the accounting equation. And here, what's the accounting equation? Accounting equation here is basically assets equal to the liabilities and the equity. And here bear in mind, the IS1 does not prescribe a right way of presenting the statement of financial position. However, based on the 8 general features, that it should be consistent with the presenting. Any method one entity chooses to use, the entity must be consistent with it. Now let's look at some of the various items on some of these elements that I just mentioned. Now assets, let's look at some of the elements under assets. We have property, plant and equipment, investment property, intangible assets, financial assets, investments accounted for under equity method, biological assets, inventory, trade and other receivable, cash and cash equivalent, non-current assets held for sale, current tax asset, and then deferred tax asset. Now let's look at some of the other stats also under, or some of the various items under equity and liability. We have issued capital and reserve, non-controlling interest, financial liability, provisions, trade and other payables, current tax liabilities, and then finally deferred tax liability. Now let's look at the statement of comprehensive income. Yeah, you are supposed to know that the statement of comprehensive income basically has two sections or two elements. The first one being the profit or loss for the period. And yeah, this is ascertained or gotten, or this is the section which shows all your incomes and then your expenses that you are recognized during the period. The second section is the other comprehensive income. And yeah, other comprehensive income at the level now that we are staying in the introduction of it, we should just know that this section will contain only items which are directly or they are recognized directly to equity and its reserves, such as changes in the revaluation surplus, gains or losses from subsequent measurements of available for sale financial asset, which is accounted for under IFRS 9. Now let's look at statement of comprehensive income, its format into more detail, the format provided. Now the first thing you have to provide in terms of the format is the revenue. You must show your revenue amount, and then you less your cost of sales. Here bear in mind that cost of sales includes your opening inventory, you add your purchases, you add your carriage, you less returns outwards, you less your closing inventory, and then you add any direct expense which can be linked to trading or to cost of sales. Then when you get this amount, you now subtract it from your revenue to get your gross profit. After you have ascertained your gross profit, there is a need for you to add any other income that you might have gotten during the year. You add all those ones to it to get your total income. Then you less your operating expenses. And your operating expenses is basically grouped under two. We have the distribution cost and the administrative expenses. Now the distribution cost basically talks about expenses in line with selling and distribution. And here some examples you can give is salesman's salary, salesman's commission, advertisement, carriage outwards, bad debt, and many others. Now, what about administrative expense? These are expenses which relates to our administrative affairs or office. And here some examples of such of these expenses we have basically office expenses, the director's remuneration, insurance, lighting, and the others. Now here, if you cannot classify any of the expense into either distribution cost or administrative expense, we are expected to recognize that rather as other operating expense. So we find the aggregation of the amounts that we can classify under distribution cost and administrative expense, and then we treat them as well other operating expenses. Now once we do this, we subtract the operating expenses from our total income, and then we'll get our profit from operations or profit from operating activities. Now after profit from operating activities, then you dive into the financing activity, where we have three components. We have the share of profit or loss of associates, we have the finance income. Here finance income is basically any income that you get which does not arise from your financing activity, which does not arise from your operating activity. Finance income is any income that you get which does not arise from your operating activity. That implies that it doesn't come under your normal day-to-day gains that you get, but you get it outside that. A typical example could be dividend that you receive. Now if you have shares in other company, the amount of interest or the dividend you receive from it, we call it as what dividend received. So dividend received here is a classical example of a finance income. Also, investment income is also an example of finance income. You might be having an investment portfolio and an income might accrue on it, and since an income accrues on it, you have to classify that item as a finance income. Now let's talk about finance cost. Finance cost is basically the cost you incur in bringing money into the organization, and this arises from your financing activity. So when we are bringing loan into an organization, we incur a cost on this loan, and this cost we call it interest on this loan. So interest on loan here is a typical example of finance cost, so it needs to be accounted for by it. So interest on loan, interest on debenture, interest on financial liability, and many others. Now we add the finance income, we less the finance cost, and we get our profit from operation financing activities, or profit before tax. After this, you have to account for your tax. You subtract your income tax expense, and here the standard for income tax expense is basically IS12. You subtract your income tax expense from it, and then you get your profit for the year. Once you get your profit for the year, then you move to the next section. Remember, we said the comprehensive income has two sections: the profit or loss aspect, and then the other comprehensive income aspect. So the profit or loss aspect ends the first section. When I move on to the second section, we have the other comprehensive income, where we say we recognize items which can be directly to equity and then net reserve. And here we have two major items here. We have the revaluation gain or loss, and then gain or loss on fair value through OCI financial asset. This was what we said is what financial assets which are available for sale. So we add these to our profit for the year, and then we get the total comprehensive income. This ends the format for the statement of comprehensive income. Let's dive into the other concepts. Now we have the statement of changes in equity. Bear in mind, the statement of changes in equity here will account for any differences in equity and its reserves. So here we will look at the various changes and the things that we need to adjust to our equity in order to get our closing balances that will transfer to our statement of financial position. Here it has column headings. The first column heading is the share capital, followed by share premium, revaluation surplus, retained earnings, and finally the total column. Now let's look at the item one by one. The first thing you have to bring is your opening balance. So you bring your opening balance with your balance BD. Then the next one, you have a prior year adjustment. Prior year adjustment accounted for under IAS 8. Yeah, there could be some instances during the year you have to adjust the figure in order to get its restated balance. So here we adjust the figures, the opening balances we have, now to get their restated balance that we are going to use for the period. So we account for prior year adjustments under IAS 8, and then we get our restated balance. Once you have ascertained your restated balance, then it comes to the changes in equity items. Now the changes in equity items, the first one we have is the dividend. Bear in mind, this dividend over here is dividend that you have paid. So dividend that you have paid to your shareholders, you need to account for it. Now dividend is paid out of profit, so we need to subtract it from our retained earnings, which is our summation of our profit. So we subtract the dividend from retained earnings. The next item is what? Issue of share. Issue of share. And here issue of share, we are going to bring it under share capital, and in case we have a premium on it, the excess of it will come to the share premium as well. Then the next item is the total comprehensive income. Here we need to bring our revaluation gain to the revaluation surplus column, and then we'll bring our profit for the year to the retained earnings column. Then we have transfer to retained earnings. Bear in mind, there could be movement in equity. We could transfer from one equity item to the other, but this transfer is in line with the concept of IAS 16, where in the case whereby an asset has been disposed of and therefore its benefit needs to be transferred, or need to also to be what derecognized from the books. In this case, its benefit will be subtracted from the revaluation surplus, and then it will be added to the retained earnings. So I'm repeating it again. Its benefit will be subtracted over here from the revaluation surplus, and then to be added to the retained earnings. Now after we have adjusted for the changes in equity item, then we get our closing balance that we are expected to show in the statement of financial position. Now let's look at the notes to the financial statement. Certain things we need to bring under the notes. Now the things we need to bring is a statement of compliance with IFRS. So we must have a statement of compliance showing that we have complied with the various IFRS and the IAS that we have. The next is the summary of significant accounting policies applied. So here we have to show some of the accounting policies we adopted in the preparation of our financial statement. Then here, supporting information for the numbers presented in the financial statement. So here, when we have some workings and all those ones, we need to support them with their relevant information as well. Then we have other disclosures such as the contingent liability and assets, unrecognized contractual commitment. All these ones we need to disclose them in the notes. Thank you.